Welcome to Smith Weekly Discussions, an occasional program for our readers and listeners of Smith Weekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. We remind our audience to examine the show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion, we want to say thanks for questions coming from our audience at Smith Weekly, including Jackie A. and Brent S. Murray Hill is our guest today. Murray is Managing Director and CEO of Marenica Energy, a uranium explorer with focus on projects in Namibia and Australia. The company also holds uranium upgrade process technology. The company is listed on the Australian Securities Exchange under the symbol MEY and also on the US OTC markets under the symbol MARXF. Murray, thanks for coming on the show.
Thank you.
Well, Murray, why don't you give the audience your background and past experience in the uranium sector?
So I'm a metallurgist by profession. I was consulting to Extract Resources on the Husab project in Namibia for about 6 years. Prior to that being sold, I've done some consulting for the Berkeley project in Spain, and was consulting to Marenica Energy when we looked at the possibility of upgrading the ore, and subsequently became CEO and then MD.
And what did you do before that? Can you speak to your work before Husab, etc.?
Yeah, I cut my teeth on gold and then moved through nickel and copper and then into uranium. And I suppose what I'm known for is thinking outside the box and looking at different options to try and improve the process and the efficiencies, the costs and so forth. So, yeah, look, probably commissioned about 12 or 14 process plants in my life at various stages, and managed a test work laboratory for a couple of years. So it gave me a bit of an insight into metallurgical test work. Worked for an engineering company for a couple of years to sort of understand the study side of things before embarking on a consulting career for 10 years and then moving into this job.
Well, very well. Are you familiar with Adelaide Control Engineering?
No, I'm not.
They have some good process solutions over there, and Glenn's a prior guest on the show. How about the uranium market, Murray? Your view on when and what moves this market?
Well, the fundamentals are there, and the supply side has dropped. Cameco have cut back, the Kazakhs have cut back, others. So they're taking somewhere in the order of 40 million pound out of the market each year over the last couple of years. So, there's certainly a supply shortage. Cameco are buying on spot. They talked in their quarterly last week or the week before about, picking up 20 million pound on spot this year. Just trying to squeeze the market to increase the uranium price. At the moment, what's somewhere in the order of 70% of the world's production is underwater, and that's not sustainable. So something has to give, and the uranium price is the thing that's got to give. Now, what's the trigger for that to go? I think the Section 232 in the States has sort of delayed things a little bit, put a little bit of confusion in the market, in the utilities' mind as to what's going to happen. And with the US consuming sort of 25% of the world's production, their stocks are dropping while they're waiting to see what the US government decides. And I think once they realise or once they get some sort of clarity there, and also realise that production doesn't happen overnight, so they may be thinking that in 12 months' time people can ramp up and Cameco can restart and Langer Heinrich can restart, but they're at least 18-month exercises. So I really think that they're probably not in touch with exactly what's happening and not realising that uranium production's years away. So they're not going to see, if they drop inventory too far, they're not going to pick it up real quickly. So I think there's going to be a bit of a scurry once they realise that, and the longer it does take to rise, the harder it's going to run. I think we'll probably see the $100 we saw in 2007, not sustained, but it'll spike there and come back down and settle at a different or lower level, but certainly a lot higher than it currently is. We're talking a lot of production around the world needs a trigger price of somewhere in the order of $65 to $75 a pound. And we're sitting at $25 a pound. So there's nothing to incentivize new production. And until that's incentivized, there's going to be a shortage of uranium. for utilities. So when's it going to happen? Could it happen this year? Could it happen in the next 3 months? Is it next year? Everybody's got a crystal ball, but I don't think anybody's got an accurate crystal ball. And nobody really knows. I think it's just going to be when utilities realise that the uranium's not there for them.
Right. I certainly agree with some of your points. And, the utilities, I do believe there are some smart people at some of the utilities. And then also there are some dumb people. And you get that a lot with these industries. And some of the energy supply industries can become complacent. Some things get missed, and obviously they missed it the last time. And it's certainly possible that they'll miss it again this time. I think that the long-term contracting will eventually be the key to really driving this thing forward. I think really all the rest of this stuff at this point, and over a couple of years, even my opinion has changed to some degree, that things like 232, things like Japan restarts and these things are really kind of a sideshow, if you will. And the main event is certainly the long-term contracting cycle. So we'll see how that goes. Well, tell us about your company, Murray. It's an interesting company name. Give us a quick overview of the company.
So the company name goes back to the farm in Namibia, which the main deposit that Marenica held a few years back. That was the name of the farm that the deposit's on. So that's where the name originated. The company is it's ASX listed, as you said before. It's a very active company. We're actively exploring in Namibia. And we've got the largest land holding for nuclear fuels over there. We're successfully exploring. I'll go through some results in a minute. And we've just done an acquisition in December last year for £48 million of 859 ppm U3O8 in Australia. So we've got some work to do on those to add value to those through our smarts. And we've, as you said before, we've got this upgrade process, which is a differentiator between us and our peers and significantly reduces the cost base. And sort of going back to Marenica itself, we are a small company. There's 2.5 of us in Perth. We've got a manager in Namibia and then consultants in both Namibia and Australia, both geological consultants, guiding us on our exploration program and acquisition program. So we're a very, very small company, low cost subsequently, and we understand it's difficult to raise money in this uranium market. So we conserve our cash and spend it very wisely.
Well, can you talk a little bit about the capital structure for us? How long do you see that the current cash will last you guys? And then also what key backers are on the share roster?
So we've got 117 million shares on issue, so a low number of shares, tightly held. With the top 50, I think the top 20 hold about 50%. My personal holding through my wife and I is we're the 6th largest shareholder, so we're invested in the story. Our largest shareholder is 9.9%, a Chinese company called Hanlong, and then sort of some high net worth individuals in amongst the top 20 as well. So quite tightly held stock at the moment. And the cash is about 1 million at the start of the year. We've got some expenditure commitments around the Australian assets. We're probably looking at raising, and we don't want to get that cash down too far before we start raising. So probably somewhere in the next quarter.
Okay. And Murray, what percentage of the shares does management own specifically, and how much do you own, and at what price?
We're all about, I think that we've got about 3.5% with the management and directors. Well, I've got about 2.5% of those. Most of us are set somewhere around the 10 cents and even higher. Some of the purchases I made prior to that were 14 and 17 cents, and the current share price is sitting at 7. So we're set a little bit higher than the current share price.
And Murray, can you speak to your approach on compensation? I know compensation is certainly an issue that a lot of investors look at or should be looking at. Can you speak to your compensation specifically, how you approach compensation, and how are you keeping a lid on general and administrative costs?
So we'll go back 3 or 4 or 5 years ago when it was really tough to raise some money. I was getting paid in shares, and unfortunately the Australian Tax Office don't see that. They see it as cash. So you've got to pay tax on those shares. So you're effectively paying the government to work for the company. I underwrote personally some of our capital raisings. So we've been through a difficult time and making sure that we didn't spend too much cash on On personnel, back then we didn't have a CFO. It was just me and a girl Friday, and no one in Namibia. Now we're in a bit better position. We do pay cash to myself and the CFO and our consultants. But generally, a few years back, we were looking at how we could pay in shares as many of our invoices as we possibly could. But that situation's changed a little bit. That's not sustainable for the people being paid. And once you're in a better position, I think all stakeholders believe it's a better thing to do to pay people cash.
Let's go back to the transaction with Optimal Mining for the Australian uranium projects. Is that deal completed? And what are the terms of the convertible preferred shares?
That was completed on December 20. We had to get shareholder approval on December 10. And then what we did was we paid, so we picked up £48.5 million of uranium assets at an average grade of 859 ppm. We paid 250,000, and I'm talking Australian dollars all the time. We're talking 250,000 cash we paid to them, and then we distributed 27.5 million shares in specie. So those convertible preference shares was a form of share that then distributed to the shareholders of Optimal, and then as soon as they got distributed, they converted to a fully paid share. So each of the Optimal shareholders received a ratio of Marenica shares according to what shares they had in Optimal. And now they're all fully paid shares, and they're traded on the market.
Let's move back over to Namibia for a minute, or actually, if you want, you can speak to the Australian projects. What's the key focus project at this point, and can you just overview what you guys are doing in both Namibia and Australia? No need to speak to Namibia as a jurisdiction. I fully understand that it's the best in Africa, so we don't need to discuss that, but let's talk specifically what you guys are doing on the ground there.
Okay, so so let's just talk about the upgrade process. It's a beneficiation process developed in-house within Marenica through some directors and myself on a technical steering committee, along with industry experts, and they include people from CSIRO here in Australia. And we've developed this upgrade process, which we have 3 patents granted over it, a lot of in-house know-how on how it works. It's essentially taking unit operations, commonly used and commonly known unit operations from, say, the gold, the base metal, and the mineral sand sector, and putting these into a flow sheet in an unconventional manner for uranium. And the reason it works is because we're dealing with secondary deposits. This upgrade is not applicable to primary deposits. So in Namibia, for instance, the Rossing mine, which has been operating continuously for 44 years, it doesn't work on their primary ore. There's paleo channels that are secondary deposits in Namibia, and there's a lot of them around. The known deposits are Langer Heinrich and Tumis, Trikopi and Marenica are the 4 sort of known deposits. We've tested our upgrade process on those ores, and they all work very, very effectively. And the reason they work is that we focus on the gangue minerals in the ore and remove those based on their characteristics before the final step is concentrating uranium. So what we end up with is we reject over 95% of the mass that's mined. So we have less than 5% of the mass to then take to a leach circuit. Now on the Marenica deposit, which is only 100 ppm roughly, we can reduce that mass to 1.5%. That low mass, high value concentrate, and say for instance at Marenica it's 100 ppm, we take it through to 5,000 ppm. That concentrate can be taken off-site and leached at, say, Rossing, who have been there for, as I say, 44 years. So they've got an established leach circuit, established uranium refinery, established reagent corridors, transport corridors, and a tailings dam. We wouldn't have to build that at Marenica, so that it reduces our environmental footprint. But we do have the option that we could put a leach, refinery, tailings dam, and reagent corridors in if we wanted to. So we've done a scoping study on the Marenica uranium project. Unfortunately, ASX won't allow us to release that because our deposit is in the inferred JORC category. Has to be indicated for ASX to allow studies to be released. So we have got in the public domain that it's about a C1 of $40 to $45 a pound. Now, what we've established is that $45 a pound means we've got probably a trigger price of $75 a pound on that project, along with a lot of our peers. But the upgrade process is the costs are mostly tonnes based. So if you double the grade, you halve the cost. If you triple the grade, hence you reduce the cost down to a third. So we've established that for a 300 to 350 ppm deposit, our costs are probably less than $20 a pound, right? Now, for less than $20 a pound, okay, uranium price currently is 25, you're not going to develop it. But at 45, $50 a pound, that's probably your trigger price. So we're ahead of our peers for a deposit that runs 300 and 350 ppm. So what our target's been over the last year in particular has been to focus on areas of Namibia that potentially could host paleochannel deposits of that sort of grade, 300 to 350. Now, down south of the Erongo region in Namibia, where the Langer Heinrich and Tumas deposits are, Tumas is somewhere in the order of 300 to 350, Langer Heinrich a bit higher at 500 ppm. We've actually pegged ground upstream of those in these old paleochannels, and we've just been drilling from July last year, and we're hitting 13 metres at 900, including 2 metres at 4,500 ppm U3O8. We just put an announcement out a week and a half ago. We hit 3 metres at just over 3,000, including 1 metre at a bit over 7,000 in a hole that was 4 metres deep. So we're talking about a drill program with success, but the drill program is only 20 metres deep. So for us to drill out, we drilled out Copies EPL. Copies 2 is the area we drilled out, a paleochannel. It's about 3.6 kilometres wide and 1.2 kilometres north to south. That cost us 64 holes. That cost us 60 grand Australian to drill that out. That is a very, very low cost for exploration. So what our philosophy is to identify mineralised envelopes around these on these EPLs we've got in Namibia to find these deposits of 300 plus ppm that we can then develop as uranium price starts to move up. So, and develop a lot sooner than our peers. So we're having a lot of success in Namibia on exploration, and we'll continue our exploration plan over there because we know we can upgrade these deposits, and we know we've got optionality on our concentrate processing. So the strategy was then, continue that. Now we've got the largest land holding for nuclear fuels in Namibia, and we'll keep exploring that this year. The strategy then was also, well, upgrade works well in Namibia, and we'll explore there. Well, what else is around that we could apply our smarts to? And these optimal assets come up for sale. All but one of them were ex-Paladin assets, and Paladin were focused on Langer Heinrich in Namibia, Kayelekera in Malawi, and Canada, and other parts of the world, and didn't really pay a lot of attention to these assets they had in Australia. So they're very much underdeveloped. And we could see that most of those deposits we can add value to through application of upgrade. So what we're looking at this year is to look at, okay, let's do some test work on some of these deposits, see what upgrade can do to it, how much can we lower the cost base. We know that the main deposit, the Angela deposit's 31 million pound at 1300 ppm, which is exceptional grade. It's got somewhere in the order of 120 kilos per tonne acid consumption. We know that in Namibia, we've removed all the acid consumers from these ores that we're dealing with, and we have a very, very high confidence level that we can remove those acid consumers and lower the acid consumption, and hence lower the cost. So the work there, and also some of the work in Australia has had a lot of drilling on it, but no resource. So we'll look at a couple of the projects and put a resource on those potentially. So really low cost, low hanging fruit to add value to those assets. So that's really where we're at, and really it's all underpinned by upgrade.
I want to talk more about upgrade in a moment, but let's go back to Namibia. So you guys, and I haven't looked at the drill results, Murray, so maybe you can fill me in. Obviously, in Namibia for the paleochannel type deposits, generally low grade at surface, which is fantastic in the economics. So can you speak a little bit more to, one, how the drilling results are beginning to delineate an actual notable deposit? Can you speak to that, and when you guys would have resource estimates coming out on the drilling results coming out of those tenements? And then also, you guys are right next to Deep Yellow, Tumas. Can you speak to the relationship with Deep Yellow and working in that area?
Yeah, so we're actively drilling. We've had 3 campaigns. We're getting results, I think I mentioned before, 13 metres at 900, including 2 metres at 4,500. I think that was from about 2 meters of below surface, and then another one 10 meters at 687, including 2 meters at 1974, and the latest one was 3 meters at I think it was 3,087, including 1 meter at 7,060. So all good grades. What our plan is to continue the exploration, the low-cost exploration program, whereby we delineate the mineralised envelope, and if we can sort of delineate a larger area and a longer channel, then we'll know that there's going to be a decent sized resource in there. So rather than go in and drill resource now on a grid pattern, and spending, maybe $1 million or so on that, we'd much rather conserve our cash, define the mineralized envelope, and then when the uranium price starts to move, come back in and resource drill it. So the area at Copies 2 at the moment is 3.6 kilometres by 1.2 kilometres. To go and resource drill that, you're probably looking at 2 to 3 months. So if uranium price moves, you kick off a study, the first thing you'll do is go in there and resource drill. So you'll have the money to do it then. At the moment, we're better off spending money, a small amount of money, on an advanced exploration program trying to define the area as opposed to trying to define the exact number of pounds in there. So that's our strategy. We've talked to our major brokers here in Australia about that strategy. I did a roadshow over the East Coast last week and talked about that, and that was well received. So that's where we're at the moment. Rather than trying to get resource pounds and really do that, and that's what DPO across the boundary are doing now. They're doing a lot of drilling to identify resource pounds. They're moving down a study path, and hence they've got to do a lot of drilling to get their resource from inferred into indicated. So that's our strategy there. In terms of relationships with neighbours, they're going about their business, we're going about ours. We have the upgrade process, they don't. So we think we're in a hell of a lot better position than them in terms of cost base. They're a bit more advanced in their exploration and they're defining the resources. But their cost structure is going to be higher than ours because they don't have upgrade. So that's where we are in Namibia.
Well, let's talk about the upgrade system. So just backing up a little bit before we get into more detail, can you clarify this system is wholly owned by the company and it has all the rights and patents? Is that correct?
That's absolutely correct.
Okay. Can you explain a little bit more on how it works? What types of facilities does it need and what types of deposit? You already mentioned some of the deposits it really can work with, so let's cross that out. But what hardware is needed on the ground and what chemicals, if you can speak to that, what's needed there? Speak a little bit more to, I know you mentioned some costs earlier, but let's speak to some all-in costs of what it takes. And can you also speak to production capacity? How much, and put this into something we can visualize.
Okay, so Upgrade was developed on the Calcrete deposit, the Paleochannel deposit of Marinika. And we then realized that we could use it apply it to other deposits of the same style. So that's what we did. And we're also learning that any superficial deposit, it's going to have an effect on. So really, basically, secondary deposits that occur in semi-arid to arid regions around the world that are all near surface. So the process itself is basically taking, looking at the minerals within these deposits, and then sort of going, well, okay, how do we upgrade the uranium? And what we establish it, rather than upgrading uranium, we're looking at the gangue minerals. What gangue minerals are there? What associations do they have? And what properties do they have? And we exploit those properties to remove the gangue minerals. We're talking quartz and feldspars and biotite, calcite, clays. So we're just looking at those properties to remove them, right? And the unit operations we're using, scrubbers, screens, cyclones, those sorts of things, right? And nobody's really in uranium understood how they could use that and what purpose they could use it for. So it's just an unconventional way of approaching it in terms of rejecting the waste as opposed to concentrating the valuable commodity. And so the final step is concentrating the value of commodity. So there's very few chemicals involved. I mean, obviously, if you're removing sort of clay minerals, you need to thicken that. So there's flocculants involved and those sorts of things. But nothing like, there's no acid involved at all. So it's not chemically attacking any of the ore. It's just working with their physical properties. So that then, because they're commonly used on unit operations, we can then take that to an engineering group and say, right, scale this up, and they have no problem scaling it up because they've used and scaled up these operations, these unit operations in the past on many different commodities. So it's a straight through process. It's as much as I hate to say it, it's a simple process because it took us a fair while to develop it. But when you we've had a few people inside the black box, and they've looked at it and gone, Jesus, how obvious is this? When you explain the ore, explain what you're doing, it is so obvious, and I can't believe people haven't thought of it. But we thought of it out of necessity. We had to do something. We were a single project company with a trigger price for the Marineka project of in excess of $100 a pound. If we didn't do something innovative, we were going to disappear up our own backside. So the option was to walk away and try and find something else to do or do something innovative. And this innovation that we've come up with is now the enabler, the catalyst for us to grow as a company. So the beauty of it is that we can put an ore, say we can build a 3 million tonne per annum plant producing 1.5, 2 million pound of uranium per annum in a concentrate for in the order of 50 to 60 million US dollars. Right, so it's a low cost capex, right, and that's producing a concentrate we can track to another site. So that's for a company like us, a small resource company, that's an achievable target, getting into production at that sort of capex. If our capex was 600 million, then it's not possible for us to get into production by ourselves. Okay. So what we can do is we can work towards getting into production of a concentrate, taking it to a third party to leach it. Now that could be simply buying the concentrate off us. It could be toll treating the concentrate and selling the yellow cake for us, or toll treating the concentrate and giving us a yellow cake to sell ourselves. So there's a number of options, and that's why I say there's optionality on the concentrate. And it's a relatively low capex entry for development for us. And because there's no long lead items in it, from the construction period is going to be no more than 12 months. And then the commissioning, you're not commissioning a leach circuit and trying to get all this chemical balance right. You're not commissioning a refinery, right? So you're only commissioning beneficiation unit operations. So achieving nameplate capacity is going to be a lot quicker than if we had a leach refinery. And if you're taking a concentrate to an established leach refinery that's been there, say, for instance, one that's been there for 44 years, well, they know, they plant so well that they're going to get maximum recovery from day one. So it's quite a novel, innovative process that we're very pleased that we own, very pleased that we developed, and our technical steering committee has a very, very high confidence level that it can be applied to all different ores. And in Namibia, we've tested Langer Heinrich ore, we've tested Tumis and Oceananas, we've tested Dracopi, and obviously developed it on Marineka. So all the Paleochannel deposits we've tested, and all that varies is the ratio of the different minerals present. That's the only thing that varies. So rejecting the minerals is the same for all the deposits, and concentrating the uranium into a low mass concentrate. So yeah, okay. It's smart technology, smart process.
So take us back for a sec. So 50 to 60 million US builds you the system, the U-upgrade system that you're referring to, the processing system. So you're coming out with an excavator, digging the shallow material, and you're sending it through a series of screens and scrubbers. Walk us through that.
So we actually wouldn't use an excavator. We'd use a surface miner, and just roll through, producing minus 100 millimeter mined material that you then put straight into a wet scrubber. So you're not dealing with drill blast. You're not dealing with stockpiles and crushers and generating dust in uranium. You're basically taking your ore straight through to a wet process immediately. So you're reducing the dust impact and OH&S issues. So basically it's a very simple, as you say, it's all, as I said before, it's all within 20 meters of surface. So strip ratios are low, and you can simply transport it to your beneficiation circuit and get it wet straight away.
Okay, and what kind of capacity for that 50 to 60 million? What kind of capacity are we talking about?
That's 3 million tonne per annum of ore.
Okay, and no problem as far as scalability.
No, not at all. That's no issue at all. In any engineering group in the world could scale these unit operations. We may have to do a pilot or a demonstration plant because it's a new process, right? But that depends on the investors at the time.
Okay, and as far as licensing at the site, no issue.
No issue. No.
So you guys had some agreements. You've mentioned some of them, and I think you'll have to update me because I'm not familiar or not up to date with some of the agreements. So you had some stuff, some agreements with Paladin. You had some agreements with Deep Yellow, and maybe some others. Can you speak to the current agreements that are in place, and what is the status of the testing?
We had an agreement with Deep Yellow on application or use of the upgrade process. Their CEO changed and didn't like the agreement. We all looked at it and thought, well, at the way we were headed down a pathway. So when we put the agreement in place, we basically had the Marinick Uranium Project and upgrade. That's all we had. And we were never going to get into production until the uranium price got to $75 a pound. So we were looking at selling third party, selling third parties our upgrade process. So when Deep Yellow came on board and said, "Oh, we don't like this," we'd already moved down the path of putting our destiny into our own hands by exploration and acquisition. So in every agreement, there's pros and cons to the agreement, and we just looked at it and thought, well, okay, we'll go along and say yes, we'll push the agreement aside because we are moving down our path ourselves. They can go and do it, go and do their thing. And if they need upgrade in the future, they'll have to come back to us. We believe they will need upgrade in the future to lower their cost base, but we'll see what happens in their study. But now instead of making a little bit of money per year out of trying to license it to a third party, we're planning to making a lot of money by applying it to our own assets. So hence, the success we're having at drilling in Copies in Namibia, 300 to 350 ppm resource, more than likely going to come out of that. We're going to make a hell of a lot more money out of applying upgrade to our own deposit than we ever would by applying it to a Deep Yellow deposit. So that was a sort of amicable agreement that we'd push that aside. And then we did a lot of work on Langer Heinrich. They've had a number of CEO changes and another one again just in the last month. So we'll go back to the new CEO when he's got his feet under the table and have a chat to them. But at the moment, we don't need third parties. We've got upgrade. We've got the edge over our peers. So we're at the stage where third parties need us more than we need them.
So speak to that just a little bit more, because obviously John Borjoff was the CEO at Paladin. He put that together, Langer Heinrich and the company. He's over at Deep Yellow. They're not interested at this time in what you guys got going. Is it the fee structure that's a problem? Is it what you guys are requiring for fees? And then two, are you guys going to build your own processing facilities in the event that nobody else, Langer Heinrich or HUSAB, will allow you to process at their facilities? What's your thoughts?
So the finer detail of why we don't have an agreement with Deep Yellow, I won't go into. It's not to do with the fee structure. We'll build our own processing plant and we'll produce a concentrate that we either take to leach ourselves or we take to a third party. We're not going to take the concentrate to Langer Heinrich. Langer Heinrich have got an alkali leach running at 92 plus degrees Celsius, whereas you go to Rossing, they're running their acid leach at ambient temperature. We've done some acid leaching on our concentrate we've produced. We produced an intermediate concentrate through the process at, say, 2000 ppm. We got 99.5% recovery inside 4 hours from acid leaching. So we're not going to go to an alkali leach with the concentrate. We don't need to because we removed all the acid consumers. So we'll go to an acid leach. So Langer Heinrich's not an option for us to take a concentrate to. But HUSAB could be. You mentioned HUSAB. They've got an acid leach and certainly a refinery that's got plenty of capacity in it, based on the fact their front end is not operating to full capacity at the moment. So. And Rossing have got excess capacity. Most of these plants have designed their refinery for a higher grade than they're currently processing. So they've all got excess capacity in their refineries that can be utilised.
So Murray, let's talk about the fee structure so I can understand that. Can you explain what you guys look for? Because I know you've done some agreements What is the fee structure? How do you approach that? And is the fee structure, in your opinion, given that you have quite a bit of experience with those particular mines, including your experience at Husab, is that fee structure sufficient to attract deals with existing mines?
I don't want to focus too much on the fee structure because it depends on the client or the third party. If you're dealing with a large company, you may be a one-off payout. If you're dealing with a smaller one, it could be a royalties type stream. But we're really focused on ourselves now, right? And we're not really looking at third party application of upgrade as much as we used to, because we've got these great assets in Namibia. We're exploring successfully, and we've got these assets in Australia we can apply our smarts to. So we're not really looking at third parties. I mean, if they come along, and as I say, if they need us more than we need them. So if they come along and talk to us, well, we'll go through the fee structure that's applicable for them. But there's a lot of options for a fee structure, and anybody can look up the internet and go, well, how do we get value out of it? And it's a function of how much value add, right? And you might go for a percentage of that value add. So you never sort of, I mean, you're only getting what part of what they're additionally making out of it. So that's where we would be if we went down that path. But we focus more on ourselves at the moment. So we really haven't given fee structures of late much for thought.
And so if you guys are focused on yourselves and you guys run this way with your costs to put in what you're speaking of at current projects, first 50 to 60 million, what would it take to go ahead and just put in what you need and finish out the process to get it right into cake in a can and deliver it?
Yeah, I suppose we haven't looked at the capex for the leach refinery. This is just the capex for a beneficiation circuit, so I'm not sure of the numbers off the top of my head. We know when we were looking at studies, we know we could reduce the capex by 50% if we put a refinery in, and then if we didn't put the refinery in, 25%. So on that basis, then probably it's another 50, 60 million to put leach refinery reagents, tailings in. So if you built your own, you're looking at 100, 120 million for your own leach refinery as well as your beneficiation circuit.
Okay, so complete, we're talking 120 all in?
100, 120 all in, yeah. If you
US.
produce yellow cake on site, that's right.
Correct, US. Okay, very interesting. And can you speak to the capacity based on what you said there?
Yeah, if it's 1.5 to 2 million pound per annum is what you've been producing out of that plant.
Very well. So what are the plans for the company in 2020, Murray? Can you just speak to what you guys are going to be working on?
Oh, the plan is to continue exploration in Namibia. We're having a lot of success. We just made an announcement last week, started last week, about what we'd achieved from the last drill program. And we've also done some ground EM, which we've identified the channel is actually wider in the east than we first thought. So we'll continue to do that EM next week and plan a drill program around that. Then we'll start moving into the adjoining EPL. We're just waiting for environmental clearance, so we'll get that hopefully in the next couple of months, and then we'll start moving into that EPL. And there's another couple of EPLs we've got that are significantly larger than Copies that will move into exploration. So really spending a small amount of money trying to identify uranium mineralization. And one thing I will say is that back in the 70s, General Mining was a company operating in Namibia on uranium exploration. They found the Langer Heinrich deposit, and they've identified a lot of prospective exploration targets on these EPLs we've picked up, which is one of the reasons why we picked them up. So we'll be going looking at those and putting a bit of EM on it and some drilling around it. But we know that 60 holes or 64 holes cost us 60,000. So $1,000 a hole on average. That's pretty low cost exploration. I don't think you'd have too many people you talk to that can say they drill a hole for on average $1,000, because most of them are drilling 200, 300 meters. So we're looking at very, very shallow exploration, low cost exploration. So we'll continue to do that in Namibia this year. Then in Australia, we'll look at adding value through application of upgrade and putting resource estimates on some of these the extensive drilling that's been done in a few of the projects.
Murray, if you guys focus on your Namibia assets is really the focus for building out a project here and producing yellow cake, if that's the route you guys go, have you started conversations with utilities as far as supply offtake agreements or long-term contracts? Or do you see that your guys' projects would be amenable to just selling in the spot market?
No, we're not at the stage to talk to utilities yet. Once we get a resource, once the uranium price starts to move, we drill out the resource around the copies, and we find it's 300 350 ppm range. Then that's the time we'll start talking utilities. At the moment, it's a mineralized envelope that we have to drill out later. So it's a little bit premature. And obviously, of course, the option too is that I don't think we'll ever go into the spot market. There's been a few people burnt from going to the spot market and staying there and not putting contracts in place. Langer Heinrich was one that did that. We'll go. The optionality is, if we go to Rossing, for instance, we might actually feed into their contracts. So there's quite a few discussions to be had with off takers, if we call that, in sort of concentrate before we start talking to utilities. But we're not quite at the stage of getting to utilities discussions yet.
Okay. Yeah, I would say, granted, given last cycle, I can't think of anybody maybe but Kazatomprom. I think everybody did a poor job of covering their ass, not just Langer Heinrich. I think everybody missed the boat. So let's talk about end strategy, Murray. Your guys' plan, do you guys really see that you guys are going to plan to develop out and become an operator, or do you guys see this company as a takeover target?
Because of the low capex, right? We will move down the path of developing and becoming a producer. The likelihood of us getting to that stage is possibly low, because we believe we'll have some very good assets, and as soon as the uranium price starts to move, we'll be a takeover target. There's no doubt. But we're not positioning ourselves for takeover. We're positioning ourselves to be a producer. And whatever happens along the way, we can't necessarily influence that. We'll just work down the path of becoming a producer, see what happens.
And what is your plan if this market drags out with no notable action over the next 3 years? What's your plan to survive out?
Well, we'll continue to value add by low cost exploration. So we might only spend 300,000 Australian dollars a year in Namibia on exploration, right? And if we can define a large envelope, it's not, the option is to hibernate and spend, call it $1 million a year roughly, right? Of sitting doing nothing, versus the option of spending another 300,000 a year building a high quality asset base. It's not much more money to explore for us than it is to survive. So our strategy has been continue to be proactive, right, and build the company up based on the upgrade process and successful exploration and acquisition, as opposed to sitting there waiting for the uranium price. So yeah, if it takes 3 years, it's going to be tougher, right, to last that long. But at the end of the day, you're getting closer and closer to that uranium price rise, and I think you're going to find uranium bulls just keeping the money coming in just to keep us going, particularly if we're exploring successfully. I don't think we're going to have a lot of trouble raising enough, because we're not asking for $20 million. We're asking for $2 or $3 million. Right? It's not a high price to pay to leverage yourself to uranium price. And on the leverage aspect, I'll take you back to 2011, after Fukushima. Right, uranium price was $50 to $55 a pound. The Husab project that Extract held was sold for $4.50 US a pound. So call it somewhere around the $6 Australian a pound. Our current market capitalisation and our known resources, right, not the blue sky we've got, we're sitting at 5 Australian cents per pound in the ground. So I'm not suggesting we're going to be the $6 that Husab was sold for, but I'm suggesting that we've got an extremely high leverage to the uranium price. Any uranium price move, we're not going to be 5 cents a pound. We're going to be a lot more than that, where it could be 50 or $1 or more. So, we're building a leverage to the uranium price by acquisition. And the more we explore, essentially the lower our value per pound is, because, if we go and put 40 or 50 million pounds somewhere in the Namib Desert, east of where Deep Yellow just added £60 million, our valuation is going to be extremely low, and our leverage to uranium price is extremely high. So that's what we're really working towards, and I believe we'll get the support to keep us going if the uranium price takes 3 years to go up. But I don't think it's going to take 3 years. It's just getting too close to the point where these utilities are going to have to do something.
If the price of uranium is $40 a pound, what would you guys do at that point?
That's a good question. If the uranium spot price is $40 a pound, the contract price is going to be 50, roughly. So it's a good question. It depends on what our assets are at the time, how much we've actually added in terms of resources in copies and other EPLs in Namibia. Interesting question. I don't know the answer because we're not in that situation yet, but quite possibly, putting contracts in place and working towards development.
So why should potential investors who are listening use Marinico as one of their uranium exposure vehicles? What would you say to them?
We're geographically diverse. We're in the best place to be in the last uranium boom was Namibia, and that's where our blue sky is. That's where we're doing low cost exploration with successful exploration recently. We've got the upgrade process which add value to these assets in Namibia and Australia, and we've got very, very good leverage to the uranium price. That uranium price starts to move, then we can only go one way, and that's way up north. And the managing director holds a fair amount of the stock, vested in the story, bought shares only 3 weeks ago. I'm a strong believer in what we're doing and where we're going, and I've got a vested interest in it.
And Murray, what is the best way for the audience to reach out to you and the company?
Email, phone call. I've never not taken a call from a shareholder. Anybody rings up, I give them the time to talk to them about it, whether they're happy or unhappy. People got questions. Respect your shareholders. They're the most important part at the moment. We need shareholders that understand the story. So I like to engage with them and keep them up to date.
All right, sir. Well, thanks for coming on and introducing us to the company.
No problems. Thanks very much for having me.